Hello traders, it's John from Trader Growth and I hope you had a profitable day today. I'd like to talk about a pattern that I think too many people trade incorrectly. There's too much information about on the internet and I want to teach you the best way to use the pattern known as the double top. You all know what it is, but the questions are, when do I use it and how do I use it? Chances are if you're trying to fade every double top, you probably don't have a profitable strategy. Understanding when to utilize this great pattern is key to making profit in the market. I'm going to let you in on some tips and secrets that I generally teach with our students. If this video helps you in any way, guys, I would appreciate a like, a comment, a sub, pass us along to anyone. I'm going to try and cut a lot of the noise and misinformation out about trading in the markets. A lot of people just don't have a damn clue what they're talking about, and they have no statistical backing on any of their setups. When we look at this double top, we're going to talk about when to trade it. There is a key time in the market when to trade it. There is a second time in the market, which is how to trade it. And there's a couple ways you can enter and exit these positions, but the reality is if you're trading this double top at the wrong time, this profitable setup is garbage and it's completely useless to you. And if you've tried to trade double tops in the past, chances are you haven't been successful. I'm going to show you why. Let's jump into the charts. Here we go. Step number one. Let's talk about identifying the market that you are in. It should be the basis of every trade. Understanding the context in which you will be taking this double top is critical. We're starting with a top-down approach and we're on the daily chart. It is critical that your analysis uses a top-down approach. So on the daily chart, we had a previous range which we were trading in, and we have broken out of that range. We've had two incredible bullish candles above that breakout range, and then we've had some exhaustion. The key to trading a double top is to never trade it into a strong trend. Pro tip, never trade into a strong trend with a double top. You'll get chopped up every time, and I'm going to show you why. As a trader, you should have a playbook. The playbook should entail when to use setups and why to use setups. When you're building your daily plan, you must already have this idea in mind. When you have been trading long enough, you will realize that when you see these candles of weakness, that there is opportunities for special plays within your trading repertoire. The double top is one of them. Let's jump into the hourly chart and see what we're talking about. On the hourly chart, you can see if we go back to the range that we were trading in, which is here, you can see we've broken out to the upside with incredible momentum. Price is following a fast moving average the entire way up. This is the hourly chart. For intraday traders, this chart is going to provide you clues and context as to when breakouts might happen, where they might happen, and if momentum is coming out of positions. Now that we see our hourly chart, and we understand that we're in an incredible trend in this direction, obviously our 13 EMA is being followed here, we're moving up. Let's jump into the 5-minute chart and we can talk more directly about double tops. I'm going to start back on the left-hand side of the chart. We're going to work our way forward, and I'm going to explain why you should not be trading double tops into a trending market. When you recognize that a market is trending, your moving averages should all be very cleanly stacked, fast, medium, and slow. When you get to an opportunity to short a potential double top, perhaps you were looking maybe in this area to short here, there's very little potential gain. As the market has so much momentum, it blows through that double top. Similarly here, we'll zoom in. If we look here, you can see that shorting your double top here in this area may have provided you with a small bit of profit, but more than likely you would have quickly been taken out on this volatility spike or volume spike that we traded to the long side. Again, if we follow our 5-minute chart along, we'll see other opportunities for double tops where they are a failure in a trending market. Here we go. You could have tried to trade a double top in here and you would have gotten slaughtered. You could have tried in here and you would have gotten slaughtered again. You can try in here and you would have gotten slaughtered again. When you are in a trending market, you do not fade double tops. They do not work. When you're in a trending market, you must trade breakouts. But when the situation changes, when you put in a fresh high and price stalls, and then we sell off, There are key things that you need to be looking for now to start checking some boxes to trade the double top. What are they? On the daily chart, you need your first sign of weakness, a sign that price has exhausted to some degree, that there is an imbalance between buyers and sellers, that no one is willing to offer it higher. We have that in yesterday's candle. Back into the 5-minute chart. That high happened here, just below $63. All of this sell-off and price action happens in an overnight session, and we continue that momentum through the next day. Now we need to start looking for clues. How do we set up a double top? Now you can see it clearly on the chart. Now, because you have the benefit of hindsight, you have all this price action. You don't have the price action headed into this move. So let's zoom in and take a look at what this looks like when you're trading it live without forward price information. You can see we have a trend that is formed now in the opposite direction of our prevailing trend. Our moving averages have now all crossed, and our fast moving averages have managed to make it below, for the first time in several sessions, below your slow moving average. Okay, that is key. That momentum, it may not be gone, but it has shifted. You should no longer be looking to buy breakouts. As soon as you see something like this happen, breakouts come out of your playbook. You now start looking for fading tops, you look for fading highs, and you look for value buying dips at known support levels. As we move ahead in our trading in the morning, we have a MACD cross below the zero line and an RSI that is oversold. From these levels, price rises. We rise until we get to 62.70. Closer to New York Open, these are clues. Where is volume? Where are things being pushed when the big money comes in? No amount of retail trading and no amount of overnight trading is going to stop a trade desk when an oil producer or a fund comes on the floor and they're ready to clobber it short. We have a moving average cross and we continue to sell off violently under the 200 period on the 5-minute chart. As price recovers in this range, there is plenty of opportunity to buy this to the long side. As buyers come in, we realize we've put in a bottom with some heavy volume. Price rises. We have our first pullback trade and a breakout to new highs. It looks like the bulls are back in control. If you're not in this long for a bounce and your idea is that momentum has come out of the market, you need to be looking for a double top. Now when you try and take this double top, this is what your chart's going to look at. What should your clues be here? That this position is no longer a breakout. It is no longer a push to new highs. Let's talk about what needs to be in your playbook to check this off your list of potential setups. A fresh high, followed by a lower low. Price moves through. After we've traded some, we make a lower high. This is key. Price moves lower. We've now made a lower low. And this is an important distinction to make. We haven't made a higher low and we haven't made a higher high. So we're confirming that momentum is coming out of the market. As we come into this previous high of day, you'll notice that volume, which is my blue bars in the background here, is low. Low volume is an indication that there are no major players looking to push or break through a level. With your checklist in mind, fresh high, new low, lower high, lower low. Your next key for this setup is divergences. We have divergence on our MACD. We have divergence on our RSI. We have a downward slope and a downward slope at the point at which we exhaust. We'll advance time, and you can quickly see this position gets clobbered and the double top is faded. I'm going to zoom in so we can get a little better price action and really examine what is happening here and why it is happening. Here we are zoomed in on our chart. I'm going to shrink our indicators at the bottom so they do not take up as much room, so we're not preoccupied with them. We already understand what the indicators have provided to us. They've provided divergence, that is confluence, that momentum is coming out of the market into the same price level. Next part. In this area where we are trading choppily, attempting to get to new highs, it is critical that we analyze the volume within that market. If your volume remains low during this period when price is trying to make higher highs, it is a very good indication that the market is thin and there are no large buyers. There is not a single candle from lunchtime, shortly after noon, where we start at 3,800 contracts in 5 minutes at 12:05, that's Eastern time. We do not break 5,000 contracts traded until over 2 hours later. What happens in here is a lot of low liquidity, smaller position traders. No one with power really steps into the market to buy this position. It's just a trickle in, trickle in, trickle in. You must identify the support level or resistance in which you are targeting. In this case, the resistance is the previous high of day. I'm not interested in the wicks. I'm always interested in the body. We talk about this all the time. I 9 times out of 10 will disregard wicks. There is not enough volume in there for me to care about. We are here in the body of these candles where we see our first sign of weakness. Our signal candle is here. We form a lower low and a lower close. Lower low, lower close candle signifies that momentum has shifted. You have failed at resistance, so now you have a defined entry and a defined stop. In this particular instance, you would look to try and get in anywhere in the length of this candle for your entry. So your entry criteria here is 9 ticks. Anywhere you can get in. You're more than likely going to have to get in towards the lower end of this. If you're fortunate, you get in at 62.62 with a stop above the high, which is going to leave you with approximately a 15-tick stop or $150 risk per contract, with a mini contract being $75 risk. After you have entered the position, it's important to understand where your profit target may lie. The profit target for this entry should be a retracement of the previous move. You may not make it all the way back to your previous low of day or the previous low of the move. I oftentimes look for my target to be where the reversal of that previous move started. We have a large red candle here, a bullish candle here, at which point we break above these previous opens and closes, and we run higher. A profit target, realistically, in this area would be 62.10 to retest the bulk of this price action on a move down. That will give you a risk reward of around 5-1. The idea is if and when this breaks, you're either going to be wrong very quickly and you will know it because the bulls will step in with incredible volume, or you will be right very quickly and there will be panic selling, as you see in this particular 5-minute candle. Nearly 23,000 contracts were traded in this 5-minute candle. Let's talk about how this candle forms and how so much volume aggressively comes into the market and flushes price so aggressively in such a short period of time. During your low volume buying period, during the quiet time of the market, I spoke about this potentially being volume by sellers that do not have deep pockets. Where do you think their stops are? Their stops are anywhere in here. The people that were up here and were buying for a breakout are stopped out 20 pips lower. The people that were here are stopped out here. The people that are at your 200 EMA are stopped out at 62.30. And here's the brilliant part. Your first pullback traders who think they have the trade of the day because they can just bait and wait. They can set their price and just let this trade all day and get the $63, $64. Wait a minute. I'm about to give back $500 a contract in profit. I better have a trailing stop in. I better have a stop loss in. I better have a protective stop. Everyone gets flushed down to the last level of previous liquidity. As a professional trader, it is your job to recognize where is the market liquid and where is the market thin. This is something that retail traders fail at time and time again, because you're trading one contract, you're trading 5 contracts, you're trading 10 contracts. If you have 1,000 contracts that you have to liquidate, 10,000 contracts that you have to liquidate, you cannot do it into a thin market. You will destroy price. Liquidation has to happen into areas of key price. Furthermore, all of your heavy volume here is proving that this is a liquid area, and when the trade is over, you can see we're right back in that area. And that is when you know you've had a good trade. Maybe you didn't take all of the profit, maybe you didn't get short all the way at the top, but you had a high probability setup. The pitfall of attempting to trade a double top is most traders just think that because price is at a previous resistance, the price will stop. That is not true. Price will only stop at that level if there has been some form of weakness introduced into the market. That is why double tops are best traded after weakness has developed from a strong breakout or a continued trend. I hope this helped you out, guys. I hope it was clear and concise. I know I'm a little intense here, but the point is that picking a double top is not just something that you see in the chart. It isn't a guess. Too many people look at Instagram, they look at YouTube, and they see someone post a 5-minute video on how to trade a double top. And when it works, it looks nice. But if you ever run the probability of what these people are teaching you, you're going to end up with a negative expectancy. To trade a double top properly, it must be traded on weakness. Keep that in mind. If you're trading it into strength, you will fail. It will not work. If this video helped you in any way, guys, I would really appreciate a thumbs up. Like, subscribe. I'm on Instagram. Check out our website. I hope you're well. Everyone, stay hungry and humble. I look forward to working with you this year, and I very much look forward to the Mastermind chat room officially launching May 1st, 2019. Let's get the money, guys. Stay hungry and humble.